Welcome back to the Deep Dive. We're the place where we take those really complex ideas and, well, we try to pull out the key nuggets for you.
That's right, making the complicated understandable.
Exactly. And today we are plunging headfirst into the world of enterprise and accounting information systems. Seriously, ever wonder how these huge companies keep tabs on every single transaction?
Every dollar, every product, every employee.
Yeah. It's way more intricate and honestly more impactful than you probably think. Our job today is to give you that shortcut, the inside track on the digital nervous system of modern business.
And that's the mission, really. We'll navigate these foundational systems, look at how tech is shaking things up, and crucially, talk about how businesses make sure all that data is, trustworthy.
Getting you the critical insights without drowning you in jargon. That's the plan.
Let's do it.
Okay, let's unpack this. We hear systems all the time in business talk, but what are they, really? Why are they so fundamental? Our sources point to two big ones right off the bat: ERP and AIS.
Right, so ERP first, enterprise resource planning. Think of it like the central brain of the business.
The brain. Okay, I like that.
Yeah, it's cross-functional. It connects everything: accounting, customer stuff, finance, HR, inventory, manufacturing, you name it.
All under one roof, digitally speaking.
Exactly. The real magic isn't just that it handles all these things. It's that it forces departments to talk to each other, breaks down those silos.
Ah, so no more finance not knowing what inventory is doing.
Precisely. Usually runs off a central database, one source of truth. Real-time communication. It completely changes how decisions get made, from guesswork to, actual integrated strategy.
Okay, that makes sense. ERP is the big brain, the orchestrator. So where does the AIS, the Accounting Information System, fit in? Is it part of the brain?
It can be. Often,
Yeah.
a good ERP includes strong AIS functions, but you can also have standalone AIS. Think of the AIS as maybe the financial heartbeat.
Heartbeat. Okay, brain and heartbeat. Got it.
It's laser focused on accounting. It's the system. Accountants, finance managers, they live in it day to day. Its job is collecting, recording, storing, compiling all that financial info. And some non-financial too, based on accounting rules.
So it's about getting the financial data right and getting it to the decision makers quickly.
Exactly. Accuracy and speed for financial decisions.
So an AIS isn't just one single piece of software then. It's more like a collection of parts working together.
That's a great way to put it. Usually there are three main subsystems, or modules, if you like. First, the transaction processing system, TPS.
The TPS. Okay.
That's the engine room. It handles the daily stuff, turning economic events, like you making a sale or buying supplies, into actual journal entries. Supports day-to-day ops.
A nitty-gritty.
Yep. Then you get the financial reporting system, FRS. This one aggregates all that daily data, plus info from less frequent events, maybe a merger or a lawsuit settlement. Its job is getting reports ready for regulators, for external stakeholders.
So TPS is daily grind. FRS is more periodic, big picture reporting. What's the third?
The Management Reporting System, MRS. This is all about internal info, giving managers the financial data they need for specific day-to-day problems. Think budgeting, variance analysis, figuring out costs.
Okay, TPS, FRS, MRS. Got it. And all these systems working together, they have specific goals, right? Our sources listed 5 key objectives.
They did. It boils down to integrity. First, record only valid transactions, stuff that actually happened.
Right. No funny business.
Second, classify them properly. Is it revenue, an expense, an asset? Third, record them at the correct value. Get the dollar amounts right.
Crucial.
Fourth, record them in the correct accounting period. Timing matters.
Proof.
And fifth, properly present everything in the financial statements. Clear, accurate disclosure.
So validity, classification, value, timing, presentation, that sounds like the bedrock of reliable accounting.
It absolutely is. That's the whole point, building that reliable foundation.
And how does a transaction actually travel through this system? What's the typical flow?
It's pretty systematic. Starts with data entry, maybe from a paper invoice. Maybe a customer clicks buy now online. That's the source.
The trigger event.
Right. Then that data gets recorded in a journal. Think of it like a diary of transactions. From the journal, it gets posted to ledgers, the official scorecards for each account.
Okay, source, journal, ledger.
Then you prepare trial balances to make sure things add up. Make adjustments, accruals, corrections, fine-tuning, basically. And only then, when everything is reconciled, do you generate the final financial reports.
It's a multi-step process with checks along the way.
Checks and balances, designed for accuracy.
And one really cool outcome of all this is the audit trail. That sounds important. Why is it such a big deal?
Oh, it's indispensable. Absolutely critical. The audit trail lets you, or an auditor, Follow any transaction step by step. From the very beginning, that source document, all the way to the final number in the ledger.
Trace it forward.
And just as key, you can trace it backward. Pick a number in the ledger and vouch it all the way back to the original source document that triggered it.
So you can verify everything came from a legitimate source.
Exactly. This two-way street is fundamental. Verifying accuracy, ensuring compliance, accountability. Nowadays, lots of these documents are electronic, of course, which can make tracing faster.
And you mentioned SOC2 engagements. How does the audit trail fit there?
It's super relevant for service auditors doing SOC2 work, especially if a company outsources its accounting, like bookkeeping or payroll. The auditor needs to trace how a transaction starts, maybe at the client site, all the way to the final output produced by the service provider. That audit trail is their map.
Makes sense. Okay, speaking of the daily flow, these transaction cycles, revenue, purchasing, payroll, they're like the heartbeat of the business operations, aren't they? How does an AIS make these cycles, well, better?
Better is a good word. More efficient, more insightful. It transforms them from just recording what happened into providing real-time data streams. Let's take HR and payroll. That affects everyone.
Good example. Always complicated.
Right. An AIS here usually integrates tightly with the HR system, the HRMS. So new hires, people leaving, benefit changes, pay rate updates, it all flows in automatically in real time.
So HR makes a change and payroll knows instantly.
Pretty much. And employees might enter their time directly into the system. The AIS then calculates the payroll, figures out how to allocate labor costs to different jobs or projects, generates the payroll register, and boom, automatically updates the general ledger.
That sounds incredibly smooth compared to manual processes. We actually have a great example. Build Pros. Regional construction company, lots of projects, high turnover. What did they do?
Yeah, Build Pros is a perfect case study. They adopted a system that really tackled their specific pain points. Onboarding. They made it digital. Applicants fill out paperwork online, W-4s, benefits info. It updates the system instantly.
Nice. What about tracking time on all those different job sites?
That was clever. They used a mobile app with geo-restricted time clocks. So workers could clock in and out remotely using their phones, but only if the phone's GPS showed they were actually at the approved job site location.
Smart. Prevents creative timekeeping.
You could say that. And the system automatically tied those hours to the right job codes. That meant accurate billing for customers. Then a simple export sent all the payroll cost data straight into their main AIS general ledger.
That really shows how an AIS isn't just about accounting, it's about solving real operational headaches.
Exactly. Efficiency, accuracy, control.
Okay, so we've got a good handle on what ERP and AIS are, how they work inside, the subsystems, the audit trail, the cycles, but things don't stand still, right? The next big piece is how companies are constantly improving these systems, using IT to really boost performance.
Absolutely. Understanding the core is step one. Step two is seeing how organizations leverage technology to refine everything. This is where IT becomes a major driver of process improvement.
And better processes mean, well, better data, fewer mistakes, sharper reporting. Our sources pointed to 4 broad areas for improvement, and then some really specific cutting-edge tech. Let's start broad. Automation.
Automation, at its heart, is about using software to do those repetitive, rule-based tasks. The things that don't need deep human judgment every single time.
Like data entry, maybe.
Exactly. Or generating standard reports, sending routine reminders. The big win here isn't just saving money, though that's often part of it. It's freeing up your people, letting them focus on stuff that needs creativity, critical thinking, solving trickier problems.
But it's not just plug and play, right? You need to understand the process first.
Oh, absolutely. You can't automate chaos. You need to really map out the existing process every step. Who does what information moves, where are the rules, before you can effectively automate it.
Okay, number 2, shared services. What's that about?
Shared services is about consolidation, taking functions that might be duplicated across different parts of a company, think HR, payroll, maybe legal or IT support, and centralizing them into one shared unit.
Ah, so instead of 3 separate HR departments, just one that serves everybody.
Precisely. It's about economies of scale, consistency, eliminating redundancy. We saw the example of the financial services firm. 3 divisions, 3 HR teams. New CEO comes in, consolidates them into one shared service center, saved, what was it, $750,000 a year?
That's significant savings just by cutting out overlap.
It can be, yeah.
Third broad area, outsourcing. We hear this one a lot.
We do. Outsourcing is simply contracting out a specific service or function to an external company. Payroll processing is a classic example. Or maybe a customer call center.
What are the pros and cons there?
Well, the pro is often efficiency or accessing specialized expertise you don't have in-house. But there are definite risks, trade-offs. You're handing over control of that function. So you worry about quality, will they do as good a job?
Yeah.
Security, they're protecting your data, productivity.
Yeah.
Language varies if it's offshore, staff turnover at the provider. You need really tight contracts and good oversight.
Right. It's not just set it and forget it.
Definitely not. Which leads nicely into the fourth area, offshore operations.
Which is basically outsourcing, but to another country.
Exactly.
Yeah.
Often driven by lower labor costs or access to specific skills available elsewhere. We see it a lot in IT support, call centers, software development, even things like accounting or tax compliance. Sometimes even knowledge work, like, believe it or not, reading x-rays remotely.
Wow. So similar risks to outsourcing may be amplified by distance and cultural differences?
Potentially, yes.
Mhm.
Communication, legal environments, time zones, they all add layers of complexity to manage.
Okay, those are the broad strategies. Now let's get into the specific tech enabling some of this. Robotic process automation, RPA. You mentioned automation earlier. How is RPA different?
RPA is a specific type of automation. Think of it as software bots that are programmed to mimic how humans interact with digital systems. They can log into applications, copy-paste data, fill out forms, move files, click buttons.
So they operate on the user interface level, like a virtual clerk.
That's a great analogy. A virtual clerk doing repetitive, rule-based tasks. What's key is that RPA is not AI. It doesn't learn or make complex judgments. It follows instructions very quickly and accurately. It's about doing, not thinking.
So automating those predictable, high-volume tasks. Can you give an example?
Sure, that logistics company example was perfect. They had tons of invoices, payment orders. Instead of people keying data into the ERP, they trained an RPA bot.
How do they train it?
They essentially showed it what the forms looked like, told it which fields to extract data from, and where to put that data in the ERP system. The bot learned to recognize the forms, scan them, grab the info, and feed it straight into the ERP. Way faster and less error-prone than manual entry for that kind of task.
Okay, RPA handles the robotic tasks. What about understanding human language? That sounds like AI territory.
It is. That brings us to natural language processing, or NLP. This is technology that allows computers to understand, interpret, and even generate human language text or speech.
Like Siri or Alexa.
Exactly. Virtual assistants are a prime example. They use NLP to understand your voice commands. In business, especially finance, NLP can be used to, say, parse through thousands of pages of legal contracts to find specific clauses or analyze earnings call transcripts to gauge executive sentiment, things humans couldn't do at that scale or speed.
Making sense of unstructured data. Powerful. And then we have neural networks. These sound complex.
They're pretty sophisticated, yeah. Modeled loosely on the human brain's neurons. You have an input layer for data, one or more hidden layers, where the complex processing happens through weighted connections, and an output layer for the result.
And they learn.
That's the key. They can learn from data. They adjust those internal weights based on past results to get better at predicting outcomes or recognizing patterns. This allows them to handle fuzzy logic situations where things aren't just black and white.
Fuzzy logic, like making judgments based on incomplete or ambiguous information.
Sort of, yeah. Making intelligent inferences. That's why they're really common in things like advanced fraud detection systems. They can spot subtle, unusual patterns in transactions that might indicate fraud, patterns a simple rule-based system would miss.
Fascinating stuff. So whether it's RPA, NLP, shared services,
Yeah.
companies are constantly changing their systems. But changing core systems sounds risky. How do they manage that?
Very carefully. You absolutely have to be methodical. You can't just rip out an old system and plug in a new one over the weekend, usually. Disrupting core functions is a nightmare.
So there are processes for managing change.
Definitely. Our door sources mentioned two well-known ones. The waterfall model, which is very sequential, step by step, and the agile method, which is more iterative and flexible. Both involve distinct phases: design, testing, deployment, review, ongoing maintenance. The point is having a structured approach to minimize disruption and ensure the new system actually works as intended.
Okay, structure is key. So let's say the new system is in, or the process is improved. How do we actually know it's reliable? That it's doing what it's supposed to do accurately and securely? This sounds like processing integrity.
Exactly. Processing integrity is a cornerstone concept. It means the system initiates and completes transactions that are valid, accurate, timely, and authorized. Basically, doing the right thing the right way at the right time.
And meeting company objectives?
And meeting objectives, yes.
Yeah.
But it also extends to confidentiality and privacy, especially when sensitive data is involved. Customer info, patient records, employee data, financial accounts. It's one of the big five trust services criteria used in audits like SOC2.
So when auditors come in for that SOC2 engagement, what kind of problems are they hunting for related to processing integrity?
They're looking for a couple of main things. First, deficiencies in suitability or design. This means either a necessary control is just plain missing.
Like they forgot to put in a password check.
Could be something like that. Or maybe the control exists, but it's poorly designed. It doesn't actually address the risk it's supposed to mitigate.
How do they spot those?
They dig into management's own risk assessment. What risks do they identify? Then they see if the controls management says they have actually line up with those risks and the trust services criteria. And crucially, are those controls actually implemented? Are they real?
Can you give a quick example using those trust services criteria? How do they help find issues?
Sure. For processing integrity specifically, the auditor would actively look for ways transactions might fail. Do they sometimes not complete? Do they take too long? Do they produce wrong results? Do they bypass necessary approvals?
Looking for the cracks in the process.
Exactly. For security, they'd probe for weaknesses that allow unauthorized access. For confidentiality, how is sensitive data handled? Could it leak? For privacy, are they following rules for collecting, using, storing personal data? They also use something called the AICPA's description criteria. As a benchmark, does the company's own description of its system accurately reflect the controls?
Okay, so that's flaws in the design. What if the design is fine, the controls should work, but it just doesn't in practice?
Ah, that's the second type of problem.
Yeah.
A deviation in the operations of controls. The control is designed okay, but it's not operating the way it's supposed to.
Like someone skipping a required approval step.
That's a classic example. Or maybe the person doing the control doesn't have the proper authority or training. The control exists on paper, but it's not effective in reality.
And how do auditors find those? Sounds like you need to see the controls in action.
You do. That's why they perform tests of controls. They gather evidence. They might ask people how they do things, observe them performing the control, reperform the control themselves, or review logs and documentation showing the control was executed.
Trying to see if it works consistently.
Consistency is key. And who is actually doing it? Timing matters too. They might test at different points in time to get a good picture. They often use sampling, testing a subset of transactions or instances of the control operating.
So they find these deviations.
Nah.
What happens next? What's the impact?
They document everything they find. Then comes the judgment call. Is the deviation, or maybe a bunch of smaller deviations together, material?
Material meaning significant.
Significant enough to undermine the reliability of the system? Does it mean there's no longer reasonable assurance that the system is meeting its objectives or its service commitments? If the answer is yes, the deviation is material.
And that affects the auditor's report.
Big time. If deviations are material, the auditor has to modify their opinion on the operating effectiveness of the controls. And if there's any hint of fraud involved, things get much more serious very quickly, potentially involving lawyers, regulators, the whole nine yards.
Okay, so maintaining that processing integrity, ensuring controls work in design and practice is absolutely fundamental for trust.
Couldn't have said it better myself. It's all about trust in the system and the data it produces. So we've laid the groundwork, the systems, the improvements, ensuring reliability. Now let's get into a really interesting space, where established frameworks meet emerging tech. Specifically, how does something like the COSO framework handle blockchain?
Ah, yeah. COSO, the Committee of Sponsoring Organizations. Their internal control framework is like the gold standard for internal controls, risk management, fighting fraud. It's been around. Blockchain. That's the new kid on the block disrupting everything. How do they mesh? That is interesting.
It creates fascinating challenges and opportunities. Let's look at COSO first. Their framework is broad, but a couple of parts are super relevant for IT systems. Take control activities, specifically Principle 11.
Principle 11. What's that one about?
It focuses on selecting and developing general controls over technology. Things like having solid IT infrastructure, good security management processes, proper procedures for acquiring or developing new tech. It's about the foundation.
Got an example?
Yeah, the Spinal Surgery Clinic, SSE. They invested in tech needing multi-point validation more than just a password to access patient accounts. That's Principle 11 in action. Strengthening tech controls to achieve the objective of protecting patient data.
Okay, makes sense. What other COSO parts are key here?
Information and communication is another big one. Principle 13 is all about using quality information. You need to identify what info you need, capture it accurately, internal or external, process it into something useful, and maintain its quality.
So garbage in, garbage out still applies.
Absolutely. The SSC example here was them adopting a data cleansing system. Why? To ensure the data they used for patient care was error-free. Quality information, Principle 13, supporting better outcomes.
And there was another information and communication principle, Principle 14.
Right. Principle 14 is about communicating that information effectively, internally, to the right people. Maybe having separate communication channels that bypass direct management for sensitive issues, using the right methods.
How did SSC apply that one?
They started doing regular reviews of key IT functions and, importantly, issued monthly internal control reports straight to the board of directors. That's Principle 14, ensuring relevant information gets communicated upwards effectively.
Okay, so KOSO provides this robust structure for thinking about controls and information. Now, drop blockchain into that mix. Give us the quick overview. What is it, fundamentally?
Fundamentally, blockchain is a distributed, immutable ledger. It started with Bitcoin, right? Transactions are grouped into blocks. Each block is cryptographically linked to the one before it, creating a chain.
Distributed meaning it's not stored in just one place.
Exactly. Copies are held by many participants in the network. And immutable means once a block is added to the chain, it's incredibly difficult, practically impossible, to alter it without detection. This happens through complex math, cryptography, and consensus mechanisms where multiple parties have to agree to validate a transaction.
So the core values are security through cryptography, transparency because many people can see it depending on the type, and that resistance to tampering.
Those are the big ones. Resistance to alteration, multi-party validation, and decentralization. For auditors, this creates a built-in audit trail. You can verify transactions using the cryptographic signatures, timestamps, addresses.
It sounds like an auditor's dream in some ways.
In some ways, yes. But it's important to remember, not all the data needed might be on the blockchain itself. Supporting details, personal info, maybe supply chain updates that could be off-chains, and auditors still need to consider it. And while it's decentralized, governments are increasingly regulating exchanges and certain uses.
Okay, so the big question. Applying COSO's framework, which kind of assumes a traditional centralized organization, to this decentralized, immutable blockchain world, where's the friction? Where's the fit?
That's the crux of it. Blockchain radically changes record keeping. Minimal human intervention, seemingly tamper-proof, irreversible transactions. It eliminates some traditional risks like someone cooking the books internally in secret.
And it creates new risks.
Definitely. The biggest challenge is often the control environment component of COS. In a truly decentralized public blockchain, no single organization has complete control. Your entity is just one node among many. There's no central management figure you can hold solely accountable if something goes wrong network-wide. That makes a traditional COSO assessment, especially for a SOC auditor, really tricky.
So who's minding the store if it's decentralized?
That's the paradigm shift. Control shifts from a central authority to the rules embedded in the code, smart contracts, and the consensus mechanism of the network itself. Trust is placed in the technology and the distributed validation.
But surely there are benefits for things like reporting.
Oh, absolutely. For financial reporting, blockchain can be huge. It offers incredible transaction visibility and data availability. Supporting financial records becomes easier, audits potentially smoother with those automatic trails. You can get reliable info to stakeholders faster.
So for SOC2 engagement on a blockchain system, what does the auditor focus on?
They still have to consider the trust services criteria: security, availability, processing integrity, etc. But relate them to each COSO component in this new context. Like, does the processing integrity of these blockchain transactions meet Principle 4's commitment to competence, considering the complex tech involved?
But you mentioned decentralization makes some COSO components tricky.
Yes, particularly Component 2, board oversight responsibility, and Component 5, enforcing accountability. In a truly decentralized system, who is the board providing oversight for the entire network? Who enforces accountability across all participants? These concepts don't map neatly. Auditors might need to adjust their thinking, or perhaps limit their scope to more private, permissioned blockchains, where there is a clearer governance structure.
It really sounds like rethinking controls. Can we pinpoint some specific COSO principles and how they apply to blockchain risks? Maybe a few key examples.
Let's try. Under control environment, Principle 5, accountability is vital. Who holds the private keys? How is access managed? Segregation of duties in a blockchain context needs careful thought.
Okay, accountability for key management. What about risk assessment?
Principle 8, assess fraud risk, is critical. You need specialists, IT, blockchain experts to even identify the potential fraud schemes unique to this tech. Old fraud risks might disappear, but new ones emerge.
Like smart contract vulnerabilities.
Exactly. Then under control activities, principle 10, select and develop control activities, becomes about controls over the nodes, the consensus rules, the smart contracts themselves, key management again. And principle 11, general controls over tech, needs policies specifically addressing blockchain's unique risks.
How about information and communication?
Principle 13, quality information is key. How do you reliably get quality data off the blockchain for analysis and reporting? You might need sophisticated data analytics. And Principle 14 communicates internally, means educating everyone involved about how the blockchain works and its control implications.
And finally, monitoring.
Principle 16, ongoing separate evaluations, becomes crucial. Given the speed and volume, monitoring often needs to be continuous and automated. You need ways to constantly scan for changes or anomalies in the network or the technology itself.
So wrapping this section up, what are the big takeaways for actually implementing COSO in a blockchain environment?
Focus heavily on preventative controls. Stopping problems before they happen is easier than fixing them on an immutable ledger. Increase the frequency of detective controls. Use AI tools maybe to help monitor smart contracts for bugs. Develop clear codes of conduct, KYC/ML policies if applicable, and definitely create cross-functional teams with clear roles and responsibilities for managing the blockchain implementation.
Wow. Okay. That was a journey. So stepping back, what does this all really mean for you listening right now?
We went from the basic systems running the business,
The ERPs and ARs.
right, through all the ways tech like automation and RPA is making them faster and smarter.
Then into how we ensure those systems are reliable, the whole processing integrity piece, and how auditors check that. And finally, landed in the pretty wild territory of applying traditional controls like COSO to something as disruptive as blockchain.
And understanding all those layers, from just basic accounting functions in an AIS to the details of how RPA works or the philosophical challenges of control in a decentralized world, it gives you a much deeper appreciation for how information actually flows, how it's governed, and how much relies on it in any modern company.
It really is the digital backbone, isn't it?
Absolutely. Every decision, big or small, rests on that intricate web of data and the systems that manage it.
Hopefully, this deep dive gives you a genuine edge in understanding that digital architecture.
Yeah.
And maybe it leaves you with a final thought to chew on.
Always good to have a takeaway thought.
How might these core ideas from blockchain, things like immutability, like decentralized accountability, how might they start to bleed over and influence the design of all kinds of information systems in the future, even ones totally outside of finance? And what new, maybe unforeseen control challenges will that future bring?